What if you and a few trusted friends could pool your money together to buy real estate in a way that is both ethical, legal, and tax your friendships? Well, today on the Furlo Capital Real Estate Podcast, that's the intricacy that we're going to be diving into as we try to equip people to invest wisely in both properties and people, even if it's in a group. And we're trying to do that because, because we want to build wealth. I'm totally off. Because we want to build wealth and improve housing. And that's what we're all about. Wow.
That's what we're all about.
I got totally off track.
I was thinking in my brain, I've been kind of wrestling with, here's the backstory. I'm meeting with a group of 20-something-year-olds. And the premise of our conversation is explaining hard topics to children, putting it in terms that a 5 to 7-year-old could understand. And we're talking about spiritual things, but this made me think what if you had to give your intro and this was a kid's podcast about real estate?
Yeah. So today we are talking about real estate and investing smartly so that you help people while at the same time getting money for doing that help.
Right?
And sometimes it's fun to do it as a team, as a group of people.
It's way more fun to do things with friends.
Yeah. So that's what I'm talking about.
I mean, that's what it makes me think of. You said pool money, and I was like, pool party.
Pool party. Yeah, 100%. Yeah, and that's because I've had this situation arise a few times. So this is 100% selfish. I have people who will come to me. It's like, hey, I would love to invest with you. I'm like, sweet, minimum's $50,000, and they go, oh, okay. And it's because they've got somewhere between $5,000 and $10,000. Right. So this podcast episode is all about find 4 other friends who also have $10,000 and then bring it together so that you can invest as a group. But you got to be careful. There's some red flags.
You can't just throw it into a pot and call it good.
Yeah, it turns out. But it's not as crazy hard as you think it is. So
all right.
There is this thing. It's called a fund of funds.
A fund of funds.
Yes.
Okay.
Yeah, exactly. So the idea is you create this investment fund, a pot of money like you were talking about, that is
multiple people's
bringing together
funds.
Let's see here. You pool your money together into a singular thing, and then that singular thing goes off and does the investment.
So which makes sense because otherwise then it would be the individuals putting their money in.
Correct.
You have to turn it into.
But sometimes you get sponsors like me where I'm like, dude, I don't want to deal with 5 small people. I just want one big one.
Sure. And
there's a way of getting around that. Now, oftentimes in the official, in the big boy investment space, what they'll do is they'll bring together 10 people who all have $100,000 each.
Yeah.
Something like that. And then they'll say and then they'll go to a sponsor like, hey, what if we drop $1 million into this deal? Can we get some better rates and stuff like that?
Yeah.
And so, but that's not what we're talking about. We're this is
numbers,
more beginner because you need to be careful. Because you're technically selling shares, this now goes into the security laws area. And so you got to be careful. So what you want to do, here's how you do it. You create a club, a real estate investment club, okay? And maybe you have 3 main goals. The first one is, hey, we're going to learn about investing together. It's kind of education based. You also are going to do market analyses and underwrite deals and look at deals.
All right.
And you're going to invest.
Do you have to do those other things?
No, but my recommendation is if you're if you're in that position where you're I would love to get into this, but I don't have the funds, spend the time doing the education, especially since you are doing it as a group.
Yeah.
Well, it can be bad.
Yeah. I mean, you'd want to know.
This looks great. Let's go.
You want to know what you're getting invested in with other people or.
Yeah. Now, my parents growing up were part of a stock investment club, and it was a very similar idea. It was a group of people. It was every single week or month or something. We'll say month. I don't know. They all contributed some amount of money. I have no idea what it was. Let's call it $20.
Sure.
But maybe there was 10 people in the group, and that was part of the, hey, to be part of this club. And I think they were a nonprofit or maybe not, but it was they had a checking account. I know that. And it was everyone always puts in money, and then they would analyze stocks and say, hey, this is the one. And then as a group, they'd say, hey, let's allocate, whatever, $1,000 to go buy this. That's the kind of thing where people do that all over the place. And again, it's a great education type of venue. And in the stock world, because everything is kind of private already, you can kind of fly under the radar in terms of like selling securities and stuff. Like it seems to be fine.
So it doesn't really matter if it's multiple people's money or if it's just your money.
No, because you're investing in the stock market, so it's all publicly traded anyways. No one really cares.
But in real estate, that's different.
Yes, real estate is different. You are potentially creating like a partnership or an LLC or what's the word I'm looking for? Or a security. Okay, so here's the thing. Here's the thing that makes it like you got to look out for, like, don't do this. If there's even one person, okay, so let's say it's you and 4 other friends, right? Mm-hmm. If there's one of you who's making investment decisions on behalf of the others, that's bad. So like, let's say I'm like, hey, I want to do this fund in this other deal. Give me your money, and like
you'll just make all the decisions.
Yeah, I'll just decide. That's a no-go. Or if it's one person who's handling all the pooled money, give it to me. I'll put it into my account. I'll make sure that it goes out and no one else has access to this account. So one of the
investors can't have control over the investment money, but the sponsor can?
Yeah, sponsors totally. Well, so we'll talk about that.
That's a little weird.
So that's the thing, right? Like in a syndication, yes, you have a sponsor and you have passive investors. But you can also do that like not officially, like it can be unofficially, where because the sponsor is the person like I'm managing everything, I'm doing everything, and passive people like don't. They just provide the funds and they walk away. Right. You can unofficially do that as well, where you have one person who's like really into it. Hey, I'd like to do this, and you get some friends who go, yeah, man, I support your dream. Let me help you out. But they're effectively passive. That's a red flag. Where if like an SEC securities person would look at that, they go, oh, you're effectively operating as if this was a fund-to-fund syndications, not an actual club. So
that's a little nuanced, if you ask me.
I think that is the differentiator. Like that's the critical piece.
How do you even do that as a group of friends? Like, wouldn't you want there to be?
I'm so glad you asked.
A designated person that you're the one who is collecting all the things and talking to the sponsor, and then you disseminate information to us.
This is so amazing. I'm glad you asked that. No, you don't. Here's how to structure it in such a way where you don't get into legal, go to jail problems. Okay. So first, you want to make sure that you invest together. So you could form an LLC, form an official, like an actual like company type of thing. And it's pretty easy to set up an LLC. And you want to have some sort of written operating agreement saying, hey, this is what we're doing. This is the purpose. And what you want to do is you want to make sure everyone is actively involved with defined roles. So you might have a treasurer, you might have a secretary, you might have a research person, you might have someone who does the taxes, you might have someone who writes the email update to the group. But effectively, you want to demonstrate, no, everyone is active. There's no one here who just gave me your money and said,
you can do different jobs, but you have to have a job.
Yes. And ideally, everyone has access to the bank account. And if you decide to do something, everyone votes and has a say and says, yes, we're doing that.
Yeah.
And should be said, like, it's probably smart to work with a real estate attorney or tax professional to make sure that it's set up right.
Yeah.
Typically, to do a syndication, it's thousands of dollars to do. This shouldn't be that. This should be a lot less because you're just essentially forming a partnership in the form of an LLC. So it's not. It still could be $1,000, but it's not nearly as much. Again, some of the benefits behind this is just lower barrier of entry, right? Like you can get in for a lot less, and the other nice part about it is you got this group of people who you're like, hey, we're learning, we're supporting, we're just trying to get better at this, and
if you
gives you access to bigger deals.
That LLC, and you have this core group of people, and the new people want to join. Is that a thing?
That could potentially cause a problem as well.
Oh,
yeah.
So once you create your pool, that's it. Like people can't go in and out.
It can happen. It just becomes a lot harder because now you have like, well, what shares what and who's sharing and what's the value of the property. You can do it. But now you're going to hire someone else to help manage the structure, and the costs start to go up a lot. My recommendation would be, got a group of people who you go, hey, let's invest in this deal together. That's an LLC. It is what it is. We all have defined roles. Awesome. if later on you're like, hey, let's do it again, I'm like,
Make a
take
new one?
that LLC paperwork, copy it, change the names of stuff and whatever, and just reuse it and create a separate entity.
Kind of like a hassle, but
well,
I also get it.
Yeah, and I mean, and once that group is done, like once that investment's done, you can rinse and repeat if you wanted to.
So I have a backup question. Why is there a minimum investment in the first place for sponsors? Which creates this issue of like, if you don't have enough, then you have to pool with other people.
Yeah.
Why don't sponsors just allow someone to give 10,000 or 5,000 or $1 million?
Because there is a limit to the number of non-accredited investors you can have in a deal before you have to actually register with the SEC, and that costs a lot of money.
Oh, so it's not worth it.
Yeah.
Financially.
It's like, let's see if I can remember the numbers off the top of my head. It's something like 20 total. And so as a sponsor, like if you're raising $2 million,
right,
you go, minimum's $100,000.
Right, because you can't have more than that.
You can have an unlimited number of accredited investors, but they're not doing this.
Yeah.
I would imagine you could have maybe a fund of accredited investors, and now you're an accredited fund, and then you can go off and do whatever. But again, none of those people are going to have like small numbers.
Right.
Right.
Once you're accredited, you've hit
a
level.
Which the whole accredited, unaccredited is dumb. It's like, it's defined. You're accredited if you're considered a sophisticated investor, but your sophistication is defined by your net worth or how much income you make, not your knowledge.
Interesting.
Yeah. Which I think is, part of their say, hey, I have enough money, you can risk it. That's kind of
yeah.
Or you were smart enough to
not going to
aggregate that much money, so we can trust you. It's a weird. It's weird. All right, so there's one thing that is complicated, or at least worth talking about, is when like you're paying your taxes and stuff like that. I think we want to be in an LLC, but you're gonna have a K1, which is kind of like the official. I'm a member of this thing, and so you're gonna pay that out, and you just want to keep track of like capital contributions, like who put in how much.
Sure.
They don't technically have to be even if you don't want them to be. Like maybe I've got 20,000, someone else has 10, another person has 10, and then maybe, I don't know, we'll just say, make my life easy, one more that has 10. Like, cool, I can do 2/5, 1/5, 1/5, 1 with, 40%, 20, 20, 20. Like that's totally viable as long as everyone has a role and they're all making decisions, right?
Interesting.
And then the other thing that's really important is just tracking all of your expenses throughout all this. So, you fire up a QuickBooks thing, which in theory should be super easy. It's like money came in, that was it. And then eventually you get paid out. And you
shouldn't necessarily have a bunch of expenses, I guess.
Yeah. So now a question that I think people get would be, okay, got to do tax stuff. Can I do it myself? So I actually got two scenarios of two types of things that you can invest in. So the first one, scenario one, your investment club, it forms an LLC, right? And it lends money to a sponsor for like a rehab. So we're doing a flip and we're saying, hey, we're looking for $50,000 loans. Yeah, cool. So let's do that. So it's paying you interest, right? That's actually relatively straightforward from a tax perspective because your LLC, it earns interest income, and then that just gets split via the K1 to its members. And there's actually like tax software like TurboTax and whatever, like they can all handle that pretty well. It's pretty straightforward.
And you just get taxed on the whatever profit you make.
Yeah, exactly. And it's just interest income. And so all you do is you track your contributions and the interest payment. Like I said, maintain good books, and you can file as a very specific form.
It seems straightforward.
K1. So very easy to do. That'd actually be my recommendation. It's also nice because it's kind of, you're backed on the amount of interest you're getting. That would be my let's start there. Scenario two is a little bit more complicated. So same thing, the LLC becomes a limited partner in a syndication. So just like any other investor, like we were talking about, right? Yeah. And so now, this is where things get tricky. So the syndication issues a K1 to the club because now it's not just interest income, now it's ownership income. And so now your LLC must issue K1s to your members, and the K1s are not just interest income anymore. Now there's depreciation, there's rental income, there's other components to it. And so now your syndication needs to file all the proper forms, but it's just built off this more complicated thing. And so that's the one where it's like, if you know what you're doing, you can do it. But the recommendation is like, no, you should hire a pro to help you out for that one. Now, the good news is it's not going to cost thousands of dollars, but it might be like $1,000.
And it's not as straightforward as like the sponsor, the syndication gives you your payout and you can't just divide that like you did with the other one. Like you did
correct
2/5, you get that much. You did 1/5, 1/5, 1/5.
I know that was kind of my it feels like it should be that straightforward. And apparently it's not. It's a little bit more complicated than that. Because again, you're not just getting like a straight single number, you're also getting this
There's other factors. But it seems like you'd be able to like factor all that in and then be like, and there's your portion. But
part of the issue is like there's a software designed to help with that. So like if you're comfortable with spreadsheets and filling stuff out,
you're like, you can figure all that out.
But you don't get a lot of help.
It's not the normal way to do the math.
Which again, that could be someone's role. It's like, I'm going to learn accounting.
I mean, that kind of makes sense because typically you would have a single investor who's and the sponsor is like, that's where things pool together.
Right.
You don't have a mini pool jumping in the big pool.
Yeah.
Which that's what you're talking about here. So
It's weird. It's kind of 100%.
A pool party in the pool party.
In theory, you could really get this thing complicated where like maybe you've got your group of friends, you're just getting started. You to create a fund to join a fund of funds, which then joins on a massive syndication. Like you could nest all this thing.
So meta.
But it's just that idea of, so here's like big picture idea, right? Let's say you want to invest with me or another syndication. You don't quite have enough money. Maybe you have some trusted friends and you can go, you know what? Let's form a club. Let's form a group, this LLC, and we're all going to go in it together. The goal is to learn what we're doing so that as our income goes up, we'll just be smarter investors as we're going. And I think if you do that, that's a really good way to get started and to get involved. It opens up access to bigger deals, like things that I'm doing that like you can't always get access to if you don't. And again, the trick is make sure everyone is actively involved, documented, and in actual life. Yeah. And if you do that, now you're all active investors. You don't have passive investors because it's when you have that manager doing things, that's where all of a sudden securities are like, whoa, what's happening here? It's more like a joint venture type of thing, more partnership.
Kind of makes sense because then you've got people who know what they're getting into and they're bought in and they're aware. It's not. There's less opportunity to have people taken advantage of. So.
Correct. Yeah.
If you're just like, I didn't know. Like I gave my money and then they took it and they did something.
Yeah. 100%. So there you go. That is how to pull your funds together with your friends.
Hey.
So if you if you're considering that, we would love to talk to you and help you invest in something with your group of friends. So you can learn more about investing with us at furlo.com. And so with that, thanks for listening. Have a great day.